Hello, this is the third video that I've done on modern monetary theory and what it implies, what it means in practice. In my first two videos, which were fairly short and therefore had to be basic just to get some main ideas across. But this one, I need to go in a little bit more depth into how the government spends money and taxes us, and what it does with that money, and this whole idea of government borrowing to cover the debt and what that's all about as well. Now, I have to say right at the outset that I am not an expert. I'm simply somebody who is curious and wants to know and understand these things. And all that I've said is very reliant on those who are the experts, the people who have written books about it, Stephanie Kelton, Warren Mosler, for example, and also William Thompson, who was the person who ran Scottonomics and did a podcast, but also ran Scotland's Economic Festival, and has set up now a thing called Scotland's Political Economy. And he's the expert that I've relied on most because I've attended lots of his stuff. So then I'll let you dive into this video if you'd like to follow it up. Well, the way that mainstream economics and the way that it is presented, the whole bond idea has been presented, and what borrowing is presented on the media. It is, as you can see in this diagram, it's understood that there are people who've got money, private savers, be it corporations, foreign banks, or individuals, who lend money to the government through purchasing bonds, and that puts money into the HM treasuries bank accounts in the Bank of England. And then the Bank of England and HM Treasury actually then is able to spend things. So we've got spending coming after the borrowing in this case, rather than spending coming after taxation. And of course, it isn't just spending after borrowing. It's actually, as you will discover later, to make sure that the balance in the current account at the end of the day is always zero, as I think I briefly said in my introductory video. But we want to be able to present an alternative way of understanding what borrowing is, what the bond market is in this presentation. Thank you. Well, the government bonds are actually a very secure way for individuals who've got a lot of money, or else institutions and even foreign central banks who want to save their money in pound sterling because they happen to have a lot of pound sterling. It's their most secure way of actually having saving money that provides an interest. Because if you own a government bond, which in the UK it's called a gilt because they used to issue the certificates in gilt-edged paper, you know for 100% certainty that the government will always be able to pay you back. So there's no other body or entity that can actually promise that, because only a government with monetary sovereignty, has its own bank and own money, such as the UK, can actually create the currency to pay you. That's what a monetary sovereignty is. And this simple fact actually underpins the whole of the financial system, not only in the UK, but any other country that has its own central bank, such as the United States, for example. So no government debt means no foundational safe asset which underpins the whole financial system. So here's a map of the institutions, accounts, and banking infrastructure that supports HM Treasury's financial activities. And of course, the HM Treasury has a number of different funds. I won't go. There's the contingencies fund, the consolidated fund, National Loans Fund, which is where all the bonds are, and then the debt management account, which so I won't go into the detail of the funds too much because all the important thing is that in order to do any of its operations, the Bank of England has to hold has to have the accounts belonging to the government. So there's there's consolidated fund account, which is what the sort of it's like the current account for the government, where the government spending goes out from. There's the National Loans Fund account, which is where the securities are held or the bonds. And there's a debt management account, and I would imagine that's to do with the fact that interest, obviously, there's a certain interest rate, so the bonds yield that particular amount depending on the length of time and the percentage of interest rate. And then you have in the central bank the reserve bank accounts of various institutions, whether it is banks or actually other institutions that do have the hold money in the central bank. So these are known as franchise banks, and the reason they are called a franchise bank is because the government has given them the legal power to issue mortgages, loans, credit cards. And I said loans, of course, because they therefore create their own what is called credit money rather than fiat money, and therefore to collect interest and grow. Now, if you have that, then of course what happens is that there's a certain amount of obligation on the part of the franchise banks to actually be able to operate to participate, I should say, in the gilts market. They're legally obliged as primary dealers to make a market for gilts on any given day. I'm going to be talking a little bit more about that and about the fact that there is a primary market and then there's a secondary market as well for gilts or bonds. But I think that's enough said on that slide. All government spending, all government transactions, spending and taxation takes place in accounts at the central bank, called reserve balance accounts. Now, this is debt spending, by which I mean that the Bank of England does not start the day with money in the consolidated fund. It starts the day with nothing in its consolidated fund. So it is therefore known as debt spending. And that is therefore fiat money, the fiat money in the bank, in the reserve balance accounts. But instead of transferring money or instead of the banks drawing that money down, what happens is that it stays in the reserve balance account as a negative, if you like, it's a debt. The banks, on the other hand, create credit money, and they create the money which they then use to pay the accounts of individuals, corporations that are the beneficiaries of government spending. Lots and lots of different transactions, obviously. But at the same time, those individuals and corporations, businesses are paying tax, either income tax or business tax or whatever it is, and also national insurance. And that is then credited, but it comes into and is paid into the HMRC account, and eventually finds its way at the end of the day back into the consolidated fund. So at the end of the day, you're going to have a little bit of money in the a debt rather in the consolidated fund. But the government. So let's see how that works out in a specific example, how the government spends and taxes. So, for example, I'm going to use a civil servant. Let's just, for the sake of illustration, say that his gross salary for the month would be £2,000. But you could apply this for institutions or NHS or anyway. So first of all, we start with the government spending. It's fiat money is credited to the bank's RBA, the bank of the person who's being paid, and they will hold a reserve balance in their reserve balance account in the Bank of England. It's a credit of £2,000. That then the bank that money stays in the because bank money has to stay in the reserve balance account. The bank then creates £2,000, and that's credit money, and it credits the individual's or the company's bank account, but in this case, the civil servant's bank account, £2,000. But at the same time, it's a taxes. If he does pay as you earn, the tax will be taken off of, let's say, £400. So that is then credited back into the bank's RBA, and then the bank then has to pay that to the HMRC. But at the end of the day, the net government liability is 1,600. So the net income of the civil servant, 1,600. The reserve balance account is 1,600, and the net government liability at the end of the day is 1,600. But as we shall see, when you combine it all together at the end of the day, there's a particular rule I referred to earlier about the balance in the consolidated fund needing to be zero. And that comes into, therefore, the whole business of borrowing. Now, the UK Treasury has chosen to operate with what it calls a full funding rule. So every pound used to purchase a government bond has, as I've said, has to come from government deficit spending. So if you get the total expenditure for in any one day, and you add to that the total revenue for the day, and then you add, then there will be a deficit in any given day, and that has to be matched by money that actually is made available for borrowing in the form of bonds. And so that the idea is that because they want to try and reach a zero balance at the end of every day. Now, to illustrate this from a year's figures rather than a daily figure, in 2024, the total expenditure was of the Treasury was 1,189 billion. The total inland revenue received in the form of different taxes was 1,058 billion, so there was a deficit of 131 billion, and that deficit had to be matched by issuing bonds for sale. This wasn't matched, this wasn't done all at once. How they do that's a different story, and how they set different interest rates, etc. So all government spending must be matched either by taxation, therefore, or borrowing, if you call it borrowing. If the government has put money into reserve balances and then it has taxed it back, it is legally obliged to match the difference by issuing bonds. That legal obligation is actually a self-imposed legal obligation, and is done for accounting purposes only. So a bond can only be bought if the government is in deficit. So you've got government spending minus tax equals the money available, which is the deficit, which is money available for dealers in franchise banks to purchase bonds. And because franchise banks have been granted powers to create money, issue mortgages, loans, credit cards, and therefore collect interest and grow, they are legally obliged as primary dealers to make a market for gilts on any given day. Well, the UK government knows that it will very rarely tax more than it spends in a given year. So it won't, very rarely does it ever have a government surplus. In fact, it isn't a good idea anyway, because you need the government debt is credit, or it's money in the economy, and so it actually has to run. It should run a deficit. So anyway, according to the rules it set itself, it must plan to issue bonds at pre-announced times during the year. The Debt Management Office issues bonds with various maturities, that is, lengths of time, um, uh, over which at which point they are redeemable, plus interest, obviously. So the debt management office will issue a gilt that will be redeemed, say, for example, in the 2073 to 74 financial year. These are held in the debt management account in the Bank of England, and it regularly also issues treasury bills, which are with maturities of 1 to 6 months, are very short. Now, the debt management office decides the maturity of the bonds. Um, so while the Bank of England's base rate policy makes sure that the gilt yields within a relatively are in a relatively narrow range. So as long as it is above the rate they pay on reserves, which is the base rate set by the Bank of England, then rationally they will always be able to sell the bonds. Under the self-imposed full funding rule, governments therefore have to create money to be converted into bonds. Now, a bond is simply an exchange of one form of money in a reserve bank account for another, which is a government security. So now, once they are available, the private dealers in commercial banks purchase these bonds, and then they can then trade that sovereign debt or in global markets. So, if you, for example, if somebody has £1,000 in their um, reserve bank account, and the interest in that is only 3%, they would much rather convert it into a bond, which it attracts an interest it's always a higher interest. So I've just put arbitrarily 3.25% per annum, that would be. So that is a securities arrangement. So then at the time of the purchase, therefore, they've got £100,000 sitting in a security. But because of the higher interest, um, after upon maturity, so every bond has a particular time set when it will reach its maturity, if you like, and then I've put an arbitrary period of 5 years here. This is just for example, and in which case the value of the bond has risen to £116,250, and that is then taken out of the securities account and then added to the ordinary bank's RBA, and that is what is known as the yield. So basically, purchasing government bonds is a simple and safe way for the wealthy to save money. They will always be sure, because the government can create the money that they need in order to make that yield. They can always be sure that it will be paid. It's very secure. Bonds held in securities reserve balance account in the Bank of England are very much like the kind of savings accounts that we have in our in commercial banks. So it makes sense to save money in an account that has higher interest. So government bonds generally pay a higher return than holding reserves directly, particularly over longer maturities. That's the period of time for which the bond is issued before it becomes mature, and therefore you reap the interest. It is repaid with interest. So when they're issued, the rational decision obviously is to earn more interest by exchanging your reserve balances for government bonds in financial markets, and they're almost as liquid as cash. But for a primary dealer, the equation is simplified, but it's simple, as I have illustrated in my previous slide. If £100,000 times 3% interest you expect to be paid on reserve balances is lower than £100,000 times 3.25% interest expected to be paid on a bond, then of course it makes sense to buy the bond. So to reiterate, every pound used to purchase a government bond has come from a previous government deficit spending and therefore cannot strictly be said to be borrowing. Private dealers using the central bank reserves purchase the bonds, as I've explained. So the Bank of England then swaps the RBAs in which these liabilities are held. So it's now held in a securities account in the HM, in the Bank of England. And then the HM Treasury uses money to do government spending, uses its own money to spend to the private and transfers money to private banks. Okay, so we come to the nub of the issue here, and that is that bonds actually do not fund the government, and so-called borrowing doesn't fund the government because, as I've said above, the government spending comes first, bond sales come afterwards, and bonds can only be purchased with money previously created by government deficit spending. And at the end of the day, bonds are sold simply to balance the spending. So it's logically true that bonds don't fund the government. So who needs the bond market? Is it the government or is it the primary dealers and bond traders? Because actually it is they that need it because by trading and dealing in bonds, what they're doing is making sure that there is a better income or more income for private investments for the private sector. So if we've decided to simply do this for accounting reasons, none of that money is collected before the government spends. And so is borrowing the right term to use anyway? Well, of course it isn't. People and organizations borrow in order to spend or save. So the UK government, as the creator of the currency, does neither. But by calling it borrowing, we're conditioned to think the government needs wealthy people's money. The current system enables the already wealthy to actually get more wealthy. So making sure that when the government spends money on public services, they get a guaranteed kickback. The whole bond system is actually anachronistic. So politicians have the capacity to take back control. Well, if only they would understand the whole business of modern monetary theory as I've been trying to present it. And I mean, I'm relying, as I've said at the beginning, on the experts. I'm not the expert. Um, but I think there's the authors of a book called Self-Financing State conclude debt issuance is best understood as a way of providing safe assets and a secure collateral to the non-bank private sector. In other words, government is doing the private sector a favor. Well, what I've just been talking about doesn't have to be that way at all. As I said, the Bank of England and the government has set up arbitrary rules, really. They're man-made, and they're based on certain assumptions about the way things really are, the way the world works, the neoliberal basis. We need, however, to have a completely different kind of system if we are going to be able to use money in the way that modern monetary theory says we can. And so these are not my ideas. They are those put forward by modern monetary theory. And I certainly learned them from William Thompson of Scotland's Political Economy. So the first thing they suggest is that we should instruct the Department of, the Debt Management Office in the Bank of England to stop issuing gilts with maturities longer than 30 years and announce a plan to reduce this by 5 years each year so that by 2032 the UK will issue only 1 year gilts. That is assuming that we are still just, as Scotland, certainly if Scotland were to become independent, they would need to only issue 1 year gilts if it's going to work properly. Secondly, they suggest remove the full funding rule to prevent any new ad hoc debt from being offered. And I said that's a self-imposed rule. And finally, we need to reduce the interest rate paid on reserves and announce that the UK will move to a zero rate. So that's quite radical. So there are still some questions that will need to be answered, and I think I've got to have to do one more video to address some of the questions that I've become aware of that need answering for people to understand and be willing to actually accept that this might be a way forward. So thank you very much for your patience in watching this video. Bye.